Hi, welcome to the Market Alert for Tuesday, the 23rd of June 2020. So yesterday we see stocks move higher, gold, oil and COVID cases soar. So we've got a disconnect now between the COVID news that we were getting last week and the market moving lower to actually it being a positive in some bizarre and strange way. So let's have a look and see what happened yesterday. We'll start off with the Dow as it's come up here. We'll just have a look at the daily. You can see the market reverse yesterday. I spoke of this in yesterday morning's market alert that we could expect a strongish move to the upside, and that's precisely what we saw. However, overnight things have been a little different, which we'll come to in just a moment. But the Dow yesterday, in its the cash trading hours between 2:30 and 9 p.m. you can see that the market sold off initially. You can see all the green bars though where they bought back into the market, and then prices moving higher, coming back to that 200 MA and then continuing to move higher. A lot of volatility in this market still, and overnight as well. As we went into the evening session though, prices calmed down a lot, and you can see they're stuck in a 50-point range. And then before the close, you see prices again being shaken out and then moved to the upside at 2045. Last 15 minutes of trade, same picture we've seen for the last 10 years. And here you can see in the night session that we've had a big shakeout here. I don't know what it's about. I can't find anything, so it doesn't really matter. The market's recovered, but the market dropping 500 points for this overnight move, which I haven't seen for a long time, a move like that where we've had a shakeout. But it didn't take long for the Fed to bring the market back to a 78% retracement, which you can see here. I'll just get rid of that, make a bit more room. From the high to the low there, and look at that, bang on 89% there, as this market has pulled back, and now we're seeing a bit of weakness. But at the moment we're above the 200 bar moving average, above the DP, remains long as prices continue to trade above these two levels. News for today, we've got some important news today. There's a lot of flash service news for the French, German. The market will be waiting for this at 8:15 and 8:30, and then there's just other medium impact. I don't know why Bailey's been downgraded. Well, I could understand why, but normally it would be a high impact. He's speaking at 9:45. I'm going to come on to him in the second part of the market alert. Something very interesting, which I could be ranting on about for a while. But first, let's deal with the markets and yesterday's trades. And let's switch over to the German Dax. Again, always start off with the bigger picture. Look, see where the market's trading, and we can see at a glance that the market's sideways. Just drag this over a bit, make it bigger. So you can see there at the moment the DAX is in a sideways range. However, prices are above the 200 MA. In the daily chart, they need to break through in order to move higher and attack the recent high that we saw at the end of May. But at the moment, we're range bound, and that makes it difficult to trade when you've got a market that is stuck in a sideways trading range. However, it does allow you to find the sort of the top and the bottom of the range as buying points in the smaller time frames. So yesterday, let's have a look. The market took off from the start. We had a sideways range in green, and then it broke out and moved to the upside. The buy signal came earlier in the session, as the would have been here, and I'll just show you, because we're trading from 8 until 10 a.m. You will see that on occasions that we get the signals in the earlier part of the session, which was here. So this market was long before the main cash market opened, and then prices continued. There are ways to trade this. If the bars are green and you're seeing the buying coming in, then you can manually enter the trade. But you will see that in the futures market from 7 a.m. We had the signal here. So I'm just going to remove that for the moment. And this meant that the market rallied strongly, and then we had a potential short trade, which let's have a look at a bit more detail in this. And again, you can see here that prices moved lower but failed to not only hit the scalp, but there was tremendous support from the psychological level, the BRN, at the 12,300 level. Now, when an order is filled and the market fails to go through the scalp and starts to trade sideways, as you can see in this situation, then it's unlikely prices are going to move lower. And if you've got profits on the table, or you can get to break even, it's a good idea to do so, or better still, to actually pull the trade. However, if you don't and you let the signals do the work for you, on this one we had a loss there of 16 points as the market came back, and then we had a buy signal as the market started to move to the upside. On this occasion, prices got to the scalp, and then as soon as we got to the open of this bar, prices drove through, and not only through the BRN, but also through the scalp, and continued to move higher. And at this point where you've got prices driving through, you're then looking for this to continue. But again, yesterday, given the market had moved significantly to begin with, prices then became sideways. And what I will do in this situation is to use the 5-bar moving average to test the strength of the market. And when prices, and also the BRN in this case as well, you've got this psychological level here, which is a support. Prices came down towards it and then continued to move higher. I'm left with two options. I can either pull the plug as prices close below the 5-bar moving average here and take the profits, or wait and see if the market will hold at the BRN. At this point, my stop is going to be below the BRN, because this is a good level to actually have a stop and lock in those profits above the scalp level. And as I've said before, the scalp level is the first profit target, in that we want to see prices drive through this, and then we'll manage the trade using the 5-bar moving average or any other sort of real target like the R1 or the BRNs or the pivot points and fibs, etc. So we see the market manage to move back through here, and then eventually it closes back through the 5-bar moving average here, indicating some weakness before it then attempts to get to the BRN up here, and then reverses and makes its way back. So if it drives through the 10-point scalp, I will then look for further signs of weakness, red bars inside of the green, and also a close below to collect profits on these trades. So from the entry point to the close of this bar is 27 points there. And then in the afternoon, as we move across, the market selling off with the Dow. Again, you see the green bars coming in to support the market. Prices then move back to the upside. On this occasion, we've got a situation where prices start at the 10-point scalp. You can see the green bars there supporting at this level as well. And when this happens, as I've said before, if you've got sideways bars, then the options are to either sit it out and see if the market will come back and take out the trade, take the money off the table, or move the stop to break even. But on this occasion, you can see that moving the stop to break even wasn't an option because of the narrowness of the trading range after hitting the scalp. So prices remain sideways, and what I did on this trade was actually move the stop to break even, but not until we'd broken the 10-point scalp. I thought I'll sit this out because I've got a 20-bar moving average as resistance, and also the BRN there. And this little spike here came down and just took me out before prices moved down to the previous day's close with the green bar, which is a good area to consider taking profits, because you're likely to get a bounce. And there you can see the market sitting on this level before reversing once more. So it was a shame because I sat through the the sideways move, and then it just came back and took me out. But that's part of trading. So not a bad day. It would have been lovely to have caught the major move on the upside in the morning session there as prices broke out. But like I say, the signal came earlier in the pre-market session. And overnight, again, you've got that same situation where you've got the shakeout there. You can see this, and you see the buying coming back in down here, and then the pullback before being moved back to whatever this was that caused the market to move lower. Okay, let's have a look at the implied volatility for the markets as a whole. This has dropped to 28.82 as the market managed to move back to the upside during yesterday's trade. Right, let's move on to a few other things that have been making the headlines. Let's start off with where we can find it. Perhaps I haven't got it here. It is. Yeah, Governor says Bank of England saved Britain from effective insolvency. Right, first thing, the UK is insolvent. That's for sure. We only have to look at this. UK public debt exceeds 100% of GDP during May. That's because the printing presses have been on fire. And as it says in this article, you will see as we go down, I'm not going to go through it line by line because it's nauseating if nothing else. It says Threadneedle Street announced a further 100 billion injection into the British economy last week to take the overall size of the bond buying stimulus to 745 billion, or 3/4 of £1 trillion. Where do we start with this? I mean, honestly, this is another interesting point here as well. It says during the 2008 financial crisis, the government failed to find enough buyers for some of its debt. That's the key word there. However, Bailey said the scale of shock in government bond markets in March and the risk of effective insolvency were unprecedented. No, they weren't. Let me show you what happened. And I was going to actually record a video about all of this. And to be honest with you, I thought, why bother? I show this stuff and then people just sort of discard it as some sort of conspiracy theory, but it always seems to come to fruition. This was what I was going to do because I discovered there was it was interesting that did the banking system fail just before the global COVID lockdown? Well, the answer is it did, and let me show you why. Here, this is what's called the asset central bank liquidity swaps, and this means the number of US dollars slushing around in the system. And if we go back to 2008, we can see that there was a liquidity problem with US dollars in central banks, primary dealers and primary banks. And this is what they had to do to refinance the system. This is a euro crisis back in 2012, 2013. And then I found this little gem here where we see this massive spike in March, which coincides with the lockdown, which term you prefer. And I thought this is interesting that, the first week of the lockup, we see that the Fed are printing masses of money. Let's just go back to what I was doing here, because what they did, they printed 2.3 trillion to stimulate, what was it called? The COVID stimulus package is what it was called. And in fact, they didn't print 2.3 trillion, they printed 4 trillion, but they only spoke of the 2.3 trillion. And if I can find it somewhere in here, I probably haven't got it now. No, it's not. But in the transcript from the White House, it said I think it's here. Here we go. It's always like to have the proof, and there you can see it. So they actually, the bill that they'd printed, or Trump had signed, and it was amazing. You want to see the video. They'd actually printed 6.2 trillion, but the stimulus package was only 2.2 trillion. So where did the 4 trillion go? Well, that's easy now, and now the bank have admitted, as we've seen here. I just come back to here, that we were effectively insolvent, and that's because there was a dollar liquidity crisis. And what was going to happen was this. I know I'm jumping around a bit here, but I just want to make these points, because when you do the search and the routing around, you actually find what actually happened. You joined all the dots together. Now, the system had broken, and I'm just going to play you a video. So just before we look at this video, I've just thought I need to talk about the 17th of September of 2019, when the system actually broke. And if you refer back to the video, third video I did about the end of the financial road, I discussed this in this video, where the overnight rate went to 10%, and its interest rates is the killer here. It's key to all of this. And you can see here all the way through to March, they were printing up towards 350 billion a night. So over to Jim Sinclair, who's in his late 80s, but in the market since he was 15 or 16 years of age, what he has to say about this. And the same thing in conclusion that I came to as well with regards to shutting down the global economy.
You know, you have been calling for some pretty awful stuff to happen in the economy, that the wheels would come off at some point. I don't think anybody saw the corona pin but we all knew there was a giant bubble. I want to start with what's your appraisal of where we are right now in the economy that you so aptly predicted was going to turn ugly at some point? Where are we now?
Well, what we've done in a fortuitous manner is stopped the general demand for money. Something was going on just before the virus hit. And please don't misread what I'm saying, but the virus in one sense is awful, absolutely, of course, but it also was quite convenient. Because in the repo market, we were supplying up to 350 billion or more a day to be able to keep the interest rates from rising significantly on the short end. And of course, all levels of interest rates affect all other levels of interest rates. Now, at the same time, the euro dollar, which is not the euro dollar is dollars in Europe on deposit, period. And they are, in Europe, similar to the repo market here, very short-term lending area of liquidity. And the euro dollar market was starting to show signs of the same crisis that was happening in the repo market. And the virus, as horrible as it was, came at an absolutely fortuitous point of time from the monetary science standpoint. We were about to have a major monetary collapse, worldwide, global, at the time the virus started. Now, there's two ways to take care of a short-term lending market. One is to pump in as much money as you can to meet the demand and therefore keep the rates from rising. The second way, and more effective, is to stop the demand for the money. And the effect of the coronavirus was literally to shut down business globally and therefore shut off demand for loans, which also shut off demands for short-term money. So what the public is not seeing, not considering, does not understand, is we were stepping into the door of a major financial crisis, magnitudes larger than what happened in 2007, 2008, 2009. So it's a horrible thing that this virus occurred, but it's a fortuitous thing, because if it had not occurred, we would presently be in a crisis much more serious than we experienced in 2008.
So as you see here, it's not just me that is who spotted this, that there was something very strange going on. And just to conclude, because I don't want to dwell on this for hours, but this, the dollar crunch that actually occurred is very, very interesting, because the Fed then set up this, what was called the FEMA repo facility. But what was the key to this? And again, everything is about interest rates. And the reason that the banking system failed in September the 17th is because of that spike on the overnight market from 1% all the way up to 10%. And once you've got this dollar crunch, you've got to find a way of printing money. because otherwise anybody that holds US treasuries are going to sell them into the market to raise US dollars. And by doing this, of course, you create a spike in interest rates. And that was the last thing the Fed needed, or any of the governments. So the FEMA repo facility reduces the need for foreign central banks to sell their treasury securities outright into illiquid markets to raise US dollars. This should help prevent disruptions to the treasury market, upward pressure on yields, i.e. interest rates. And that's what it was all about, as Jim said, as well, with regards to shutting down the global economy. And that 4 trillion that was mentioned or not seen, was mentioned but not seen, went to actually put the liquidity back into the banking system and to stop a collapse. Anyway, there you go. That's a brief synopsis, but I think it was about 12 hours of research joining the dots together many weeks ago. But it's very, very interesting that we now see this, where it went nearly bust, and that's because it was bailed out the same as the other ones as well. Okay, with that, I will conclude. As ever, thanks for watching. See you in the next.